Thanks for downloading this episode of the Resilient Advisor Podcast. My name is Jay Coulter, and on this episode, we are going to be discussing cryptocurrencies, tokenization, and the blockchain with Dan Raykhman. Dan is a fintech veteran with over 25 years of financial services industry experience. He has spent over a decade developing financial products, working with ETF issuers such as BlackRock, Guggenheim, Bank of New York, and Direxion. He is also the CEO and co-founder of Fungible Network. Dan, thanks so much for coming on this podcast.
Hi, Jay. Thank you very much for having me.
All right, so I'm a novice when it comes to an understanding of cryptocurrencies, tokenization, and the blockchain. So I'd like to conduct this interview through that lens so that listeners who really need a good 101 course on it can really get some value out of this interview. So why don't we start first with cryptocurrencies? What's all the fuss about? Why are they revolutionary?
So if you look at cryptocurrencies and the way they were originally envisioned, it was a new digital entity where creation of this asset, if you want to call it, was not controlled by any government or any company for that matter. It was a technological innovation that set out a set of rules, and once those rules were programmed, implemented, the cryptocurrency, in this case Bitcoin, just basically functioned autonomously on its own and became a unit of value, if you will, and became a mechanism for transferring that value from one participant to the other.
All right, can we...
So this type of...
No, please, Dan, excuse me.
So this type of autonomous value creation and value transition never existed. Currencies historically were always issued by governments, controlled by governments. The supply was controlled by governments. And all of that now in the crypto world is controlled by computer programs with the rules set out and transparent to everybody involved.
So what are some of those rules?
So in case of Bitcoin, the set of rules, there's basically a limited supply. The 21 million Bitcoins will be issued, and that's it. There's a number of Bitcoins. So right now, every 10 minutes, 12.5 Bitcoins are being created and awarded the miners that generated the next block, right? So essentially, that's the rule that governs how many Bitcoins are out there. There's a rules that determine how blocks are being created. Each block is being created every 10 minutes. There's a rules that determine the size of the block. That in turn determines how many transactions can be confirmed in the 10-minute period. So all these rules were set out and published and then programmed. And originally the rules were written in the white paper, in the famous white paper by Satoshi Nakamoto. I mean, we don't know who that person is, but those rules were adapted and programmed in what now is known as a Bitcoin.
All right, so 12.5 Bitcoins are created or mined every 10 minutes. How are they mined? What's that process?
So the way the Bitcoin works, and that's more or less the same algorithm or the concept is implemented with other cryptocurrencies. The Bitcoin is operating on something called proof of work. Essentially, miners are kind of running a contest, running a competition. Each mining computer is trying to determine the next hash. Hash is a string of alphanumeric characters where there's an algorithm. Again, it's a well-known algorithm that takes the one block of data, which is 1 megabyte, and that algorithm allows to take that number and compress it into a 64-bit string of characters. And you adding what's called a nonce, which is an extra character at the end of that 1 megabyte block to change the value of the hash. And the first computer or the first person that finds that hash that has the first 5 zeros gets to generate the next block. And every time the hash is generated, so essentially you have a block of data, which is essentially a record of transactions. That block is condensed to a hash, which is 64-bit string. That string is put into the next block, and then all the transactions are written into the next block. Then the next block is condensed to that hash. Therefore, you have chain of blocks. And if you change any of the character in any of the previous blocks, it will change the value of the hash, and therefore you're changing the entire blockchain. That's what makes that process secure, because every computer, every miner that participates in the mining process has a copy of the blockchain. And every time new block is generated, that information is propagated to all the miners, and they all go to work trying to determine the next hash and trying to generate the next block. The computer that does it first gets the reward of 12.5 newly minted bitcoins.
So
right?
how many computers are trying to mine right now?
I don't know the exact number, but it's in the 20,000 range.
Okay. And can anybody set up a computer and try to mine tokens or mine blocks?
Yes, you can. Right. The problem is that obviously the faster you can calculate that hash, the bigger percentage or better chance you have to be the next computer that generates the proper hash, right? So at some point a couple of years ago, there are smart people that designed a computer chip specifically built to do these calculations very fast and very energy efficient. And if you try to do mining using general purpose computer, you would be outgunned and outnumbered. So you need those special purpose computers to mine Bitcoin. And they're for sale. You can find them on eBay and some other places, and they go for $3,000 to $5,000 last time I checked.
Okay, so now we have some numbers to put on this. So $3,000 to $5,000 for a supercomputer that's designed to mine. Right. What type of ROI could an investor get out of that?
Right. So there are 3 components, if you will, to that process. Right. There's a cost of the original equipment. Then there's the cost of hosting that computer, and obviously there's a cost of electricity. There's a company called Bitfury, which is one of the major mining companies in the world, and the CEO of that company stated recently that the cost of mining for them is about $3,000 per Bitcoin.
Okay, so then if there are 20,000 computers out there mining, is it safe to say that they all have these chips that are necessary to optimize the process, or do you still have folks trying to do it with old technology?
No. It's very difficult to do this with the old technology. There are 2 types of mining machines and 2 types of algorithms that different cryptocurrencies employ. For instance, Ethereum it has a different cryptography algorithm employed in the construction of their blocks, and Ethereum was designed to work on the GPU, on the video cards, using the video cards. So that's why if you try to buy a high-end video card right now, they're very difficult to get, and at best, if you go to even Amazon, they usually sell maximum 2 cards per customer. So I'm sure you've seen pictures of the mining rigs where it would be one open-air computer, and that one computer holds anywhere from 6 to 12 video cards, because each video card does the mining of the cryptocurrencies like Ethereum, Zcash, and some others.
Okay. So here's one of these novice questions for you. do I then safely assume that these 20,000 computers that are mining, that is the blockchain?
So the blockchain refers to the actual blocks of data. So every time you have a cryptocurrency transaction. So let's say I have a wallet and you have a wallet, and I'm sending 1 Bitcoin to you. So that record where Bitcoin was moved from wallet A to wallet B is written into the block of data, right? And as I said before, that block, which is 1 megabyte of data, is then reduced to a 64-bit string, which is called a hash. So that string is put into the next block. So when you look at that next block and you have that string, 64-byte string, you can look and see if that string matches the previous block that you have on record. So if somebody hacked into this whole system and changed the previous block, let's say change the value of the transfer that I did to you and change it from 1 Bitcoin to, let's say, 10 Bitcoins, that hash string will not match that changed block. So that structure will have a block, and then the hash of that block put into the next block, and that next block would have its own hash, and that hash would be put into the next block. That would create chain of blocks or blockchain.
Okay.
Does that make sense?
I think at a high level, I can get that conceptually now. Hopefully listeners can as well. Let's pivot just a little bit and talk about tokenization at a very, very basic level.
Sure. So even though originally cryptocurrencies were designed to function completely separate from the traditional financial system, there is a process right now where these two worlds, traditional finance and crypto finance, are merging to some extent. So in reality, if you look at financial markets overall, people were always buying assets in different containers or in different wrappers. If you wanted to buy gold, you can buy physical gold, but then you have to worry about security, transportation. It's not easy to kind of keep physical gold, for individual investor. So for an individual investor, a much better proposition is to buy a gold ETF or gold futures contract, or maybe a long-term option contract, right? So this type of instruments are wrappers that give investor exposure to a particular asset. Crypto is just another container. It's a different wrapper with a different set of attributes. And therefore, for some investors, it would be a better option to buy, let's say, again, gold in the crypto format. So crypto in itself is a secure digital record. Anything can be written in that record, and whatever is written in that record stays there forever, right? It can be traced. Okay. So as long as the link between that digital record and the underlying asset is secure, transparent, then investors will buy assets in crypto format when they feel that that particular container gives them attributes that they're looking for. Does that make sense?
It does.
Yeah.
Yeah. So
if we can talk about different attributes.
Yep.
So why would people buy, let's say, crypto or assets in crypto containers? Well, first of all, it's fractionable. For instance, if I want to buy Amazon share, that's $1,600. But if a small investor somewhere in Africa or in China wants to buy $50 worth of Amazon, it's not so easy. So crypto tokens or cryptocurrencies, they're fractionable. And as long as somebody is willing to sell it to me, I can buy 1/100th or 1/1,000th of an Amazon-backed token. It's mobile. I can keep it on my phone. I can travel anywhere in the world, right? In theory, the crypto tokens are available to the investors worldwide 24/7. So there are a lot of investors looking at this type of tokens. The liquidity could be much better for this type of containers, and the market is open 24/7.
I'm just thinking for a company issuing shares, if it was done on this platform, it doesn't seem like it'd be possible to have somebody in the marketplace shorting your shares if it was issued through these containers. Is that fair?
Not really, because if you look at traditional finance, if you're trying to short the shares, your broker is actually borrowing shares for you, and then you're shorting the shares by selling shares that belong to somebody else. And at any point in time, the shares may be called back, and therefore there'll be a short squeeze where you have to buy the shares in the open market and return them. Effectively, if you look at cryptocurrency trading, there's already different brokers or different exchanges that offer their customers ability to either trade on margin or short cryptocurrencies. And the mechanism is the same. They're just borrowing the, let's say, Bitcoins that belong to other clients of the same broker or exchange to sell those Bitcoins short. Same scenario would work here.
Got it. I did not realize that. So is that, if somebody wanted to short cryptocurrencies, is that the optimal approach, to find somebody that would let you do that on their platform?
It's one of the approaches. Another approach is since now we have the Bitcoin futures trading on CME and CBOE, you can sell the futures contract, right? So that becomes another option to do that.
Interesting. Okay. What else do we need to know about tokenization?
So I think if you look at tokenization, in my opinion, if you look at, again, traditional investable funds, they used to be closed-end funds, and then the innovation took the closed-end funds into the mutual funds, and the ETFs were developed, again, to give investors better options, less friction, secondary market trading, and so on and so forth. So in my mind, tokenization, let's call them crypto-traded funds, is just, again, evolution of the investable market. It makes it easier for investors to go in and out. It allows us to create a market where these crypto-traded funds can hold any kind of basket of securities, any basket of assets. What's interesting about ETF right now, any ETF can hold multiple securities, a basket, right? But that ETF, a U.S. ETF, can only hold securities that trade in the United States. The crypto-traded funds are opening a new chapter where now we can put together a basket of securities that don't necessarily have to trade on the same market. There could be a Chinese stock, an Indian stock, a Russian stock, and let's say Brazilian stock, and you can have a new definition of the BRIC basket. And I think this is an exciting part for me. There'll be a lot of smart people looking at this vehicle and designing baskets of assets and securities that were never possible before.
Wow. Yes. And so then there has to be some legal ramification to all this in the SEC. What does that landscape look like right now?
Oh, it's a very interesting question. I think regulators all over the world are very much in a bind right now. I know that last summer, SEC had about 30 attorneys looking at crypto, and right now it's over 200. So SEC and other regulators are really scratching their heads trying to catch up with the market. Again, interesting thing about this particular market, even though the SEC regulates U.S. markets, but people creating this type of crypto token funds can easily go offshore and look at regulatory arbitrage, look for the friendliest jurisdiction, if you will. And we see examples of that. Gibraltar right now is very crypto-friendly. Malta just announced that they'll be very crypto-friendly. So at the end of the day, at least in my view, these tokens have to be compliant. People need to pay taxes, and investors have to be protected. But at the same time, I believe that regulators have to also kind of deal with this market with the kid gloves to make sure that they don't kill it, to make sure that they allow this market to benefit large and small investors alike.
God, so the applications to this really do seem endless. Like you could put together a pool of physical gold and then issue tokens. Could you pull together some commercial real estate properties, issue tokens?
Absolutely, yeah.
Okay, so here in the I'm sorry.
No, finish your question.
So if I'm here in the United States and I'm a fund manager, can I go and say, all right, I'm not going to deal with inside the rules of the SEC anymore. I'm just going to do this all based on the blockchain, and I'm going to manage my fund accordingly and then go out and sell the tokens. Is that legal at this stage?
It's not necessarily legal. Well, it really depends, right? If you can do this, so effectively you can have two types of funds. You can have a passive fund and an active fund. And a passive fund would work just like any ETF today. You have an index, and your fund is trying to track that particular index. And whatever the assets are in the index, in theory, your fund would hold as well. If you have an active fund, then you could be a manager and you can buy any assets you want, and every day you have your custodian, an administrator calculate NAV of your fund, and then you can have creation and redemption of those shares where investors can come in or take the money out of your fund, and you have full discretion. You trade fund actively. You can do it in the United States and you can tokenize the fund, but the SEC would regulate who can buy into that fund, and essentially it would be accredited investors. And based on the rules of our regulators, SEC, the secondary market of these tokens is regulated as well. Meaning that if I invested into this fund and I bought, let's say, 10 tokens, I cannot go and just sell them in a private sale to some other investor in the United States, because that token will be deemed a security, and securities can only trade on the exchange. So, for instance, if I buy an Apple share from E-Trade and I call the broker and ask for them to issue that certificate in my name, and I'm sitting across the table from you, Jay, I cannot sell that Apple share to you. I can sell you an iPhone, I can sell you a car, but I cannot sell you a $173 Apple share, right? So in the case of actively managed fund, the same thing. That token can be created. It could be a good way of keeping an accounting of my fund and keeping an accounting of what's my daily NAV calculation looks like. But the secondary market for the token would be regulated, and you'll be able to trade that token, but it would have to be on one of the regulated marketplaces, like an ATS, Alternative Trading Systems, or T0 is one of the crypto exchanges that is emerging right now in the United States that potentially will be fully regulated. These tokens will be able to trade there. If you take that structure offshore, let's say you go to, again, Gibraltar, or you go to Cayman Islands, and you register that token there as an exempt security, for instance, then you'll be able to allow investors to come in and buy those tokens. And these investors, in theory, can trade on the secondary market these tokens, but the secondary market will not be available, at least today, to the U.S. investors. Does it make sense?
Yeah. So it seems to me that there's some pretty great applications there in the private equity space in terms of either taking a company either public or pooling investor funds to go out and invest in private equity funds. With the key component, what it sounds like to me is that the structure needs to be offshore. Is any of that fair?
Yes, exactly. Yes, and if you look at real estate kind of partnerships, you look at venture capital, you look at private equity, the biggest problem with all of those structures is lack of liquidity for, let's say, 5 to 10 years, right? 7 years on average in the real estate world. So if you have these funds tokenized, then in theory at least, you can have that investment liquid from day one.
Wow.
You may not be able to sell it for full value if it's a fire type of sale, right? But there'll be some liquidity at least.
Yeah. That's fascinating. All right, so tell us a little bit about Fungible and what you guys do and how it works.
So, as you mentioned in your introduction, my background is ETF design and ETF issuance. I started looking at crypto about 2 years ago, started looking at different funds or different cryptocurrencies, and it struck me that there were a number of cryptocurrencies backed by real assets. They're currency backed by dollars, gold, real estate. But from the financial product standpoint, this link was at best questionable. None of these tokens I was looking at had a real custody. So it was very unclear who is holding the underlying assets. And most of the time, it was the issue of this token itself that was holding the underlying asset. None of them had daily NAV calculations. Nobody was doing audits of the underlying assets. And it's, again, coming from the ETF world, all these issues were addressed. And we figured that the cryptocurrencies will evolve and will have the same requirements. That's how Fungible was born. Fungible is a platform where tokens backed by virtually any asset can be created. We're working with traditional custodians, traditional administrators. Every time we issue a token, the corresponding amount of the asset goes into the custody, and the holdings for each of the tokens that we have in circulation has a daily audit that verifies that the asset that has to be there is there. And all of this information is published on the blockchain.
So can you give me some examples of the types of assets you're doing this for, the types of pools of assets?
So the initial set of tokens that we are looking to issue will be backed by fiat currencies, fiat currency baskets, and cryptocurrency baskets. So we'll have a token backed by $1, token backed by euro. Essentially what we're doing, we're creating a cryptocurrency equivalent of the fiat currency. And the reason we're doing it is because if let's say you and I doing a transaction and I am buying a Bitcoin from you and I have to pay you dollars. Right now, the one leg where you need to send the Bitcoins to me, it's kind of easy. I'll give you my wallet address and you can go to your wallet software and just send Bitcoin to Dan Raykhman. But for me to send you the dollars, I have to go through a bank, do the wire transfer. You have to wait at least 24 hours to get that wire, right? So there's a lot of interest in kind of moving that transaction into the crypto world where both legs of the transactions are done in crypto. So there's a need for crypto dollar. There is a token called Tethers, and I'm not sure if you heard of it, but
no.
It was designed to be equal to $1. It's 1-to-1 to $1. But again, it has no custody. Nobody knows. They refuse to actually say what bank is holding the funds. There is no audit, and yet there's over $2 billion in these tokens in circulation. And if you look at the daily volumes, there's a website called CoinMarketCap that shows you different values of different coins. It shows you how much is being traded. And if you look at, let's say, top 5, Bitcoin, Bitcoin Cash, Ethereum, Ripple, Litecoin, they trade on average somewhere between 2 and 5% of the total market cap. Tether trades over 100% every day. And even though it's very questionable, very problematic, because, again, the link to the underlying is not there, is not visible, just because there's such a need for dollar equivalent or dollar surrogate in the crypto world, that token trades so much and it has such a high demand. So we're looking to replace that with the dollar-backed token, with the real custody, with the real daily audit, where if you buy that token, you're holding that token. And by the way, we'll share the overnight interest rate with the holders of the token. So essentially, it will be like holding a money market account.
So
Another type of tokens.
Hey, Dan, can I ask a question real quick? So if you're in Venezuela or another country that is experiencing high or hyper levels of inflation, this would be a layup for them, right? To go and move what assets they have to protect them?
Absolutely. And actually, if you look anytime the unrest flares up in Venezuela or Iran, the number of cryptocurrency transactions in those countries goes 10x. So that's another great application of what cryptocurrency are doing in the world. It's just making people that are, have so many problems, at least it gives them the ability to kind of take care of their capital. If you live in Venezuela and you have $100, what do? You can't take it to the bank. You put it under the mattress. But if the police comes and just finds your money and take it away from you, you have no recourse whatsoever, right?
Yep.
So if you have that money moved into the crypto world, you're way better off. And again, you can travel with that anywhere you want to go.
So Dan, I've read a couple of articles about, I don't know if I'm using the correct terminology. I've read articles about people losing their money from their crypto accounts. Could you tell listeners from just a high level what has happened and then some things they could do if they choose to enter this space to protect themselves?
Right. So I think it's on average every 2 months, there is a big story of a hacking problem. Exchanges are being hacked. What we need to make a distinction between the blockchain security itself, security of Bitcoin itself, and the security of different wallets that hold the security. All these hacking scandals, all the stories is when hackers were able to get control of a particular wallet that was holding certain amount of cryptocurrencies, and then they were able to transfer that cryptocurrency out of that wallet to their own wallet. And the way to deal with that is there are a number of ways that people should be able to keep their own cryptocurrencies safe. Obviously, big companies like Coinbase are doing a lot of work trying to make sure that if you open an account with them, that your account is safe. Called hardware wallets. You can buy, and I don't even remember the names of the companies that sell them. It looks like a USB drive, but there is a wallet software on top, or inside that USB, and you have an address. So you plug it into the computer, and you can transfer your cryptocurrencies to that hardware wallet. Then you unplug it, and you keep it, in a safe space. And that wallet, that hardware wallet, has tokens. Obviously, while it's not connected to any of the computers, it's impossible for hackers to steal anything from that wallet.
Okay.
So it's a combination, I think, of people still have to educate themselves.
Yeah.
I'm sure you've heard horror stories of people kind of getting Bitcoins and then writing down their wallet addresses and then losing that piece of paper. That could be a problem. You could lose your Bitcoins that way.
Mm-hmm.
So people have to be careful.
Okay. Excellent. So what else do listeners need to know about your company, and how could they find out more information?
So I mentioned that the fiat currency baskets. I'd like to talk for a second about cryptocurrency baskets. For people that are new to the crypto world, it's probably better to look to invest into a basket. So if you just want some exposure to crypto, buy top 10 currencies, for instance. If you want to invest $1,000, buy $200 worth of Bitcoin Cash, Ethereum, Litecoin, and some, maybe Ripple, maybe, I don't even know what, I don't want to mention specific currencies other than, again, you can go on market cap and take the top 5. As you know, it's very difficult to determine which particular stock is going to go up or down. If you want exposure to an equity world, you're better off buying an index ETF. Same story here. And what we're trying to do at Fungible, we are in the process of creating tokens that will be backed by crypto baskets, Crypto 5, Crypto 10, Crypto 20, and people will be able to buy the token where system goes and automatically buys all underlying components in the proper proportion. and we have the basket rebalancing functionality in place. So I think that's a very good way for new investors to get exposure to cryptocurrencies. There are also other companies that are doing crypto index funds. I don't know of companies that are doing crypto tokens, but crypto index funds, Coinbase has their own crypto index funds. There's another company called Grayscale. There's a company called Bitwise that also offering crypto index funds. If people want to have exposure to crypto tokens, I would encourage them to look into buying baskets.
Okay, excellent. And how could listeners find out more about your company?
So as you said, the name of the company is Fungible Network. Your listeners can find us on Twitter, on LinkedIn. I am pretty active on LinkedIn and Twitter. People can find me. My handle is DA and then my last name, Raykhman. I'm both on Twitter and LinkedIn. I'm happy to answer any questions people have.
I will have links to all of that information in our show notes. Dan, before I let you go, this is one of the longer podcasts I've done in the past year and a half, and it's just been packed full of amazing information. It's been a great learning experience for me. Can you tell us what is the most exciting part right now of tokenization?
For me, Jay, it's this possibility of all sorts of different baskets that people can design and bring to the market, really creating a new wave of financial products that never existed before. I can't wait to start seeing these products coming to market.
Dan, thanks so much for coming on the podcast.
Thank you, Jay. Thank you very much for having me.